The silent hand weakening the rupee. Currency markets are often portrayed as free, unpredictable, and driven purely by supply and demand. Yet in Pakistan, the rupee's trajectory tells a different story, one in which the State Bank of Pakistan (SBP) plays a decisive role behind the scenes. According to recent disclosures, the SBP has purchased nearly $7.8 billion from the domestic market between July 2024 and May. The result: a weaker rupee against the US dollar, hovering around 280 rupees per dollar, even though policymakers such as Deputy Prime Minister Ishaq Dar argue the real value should be closer to 260 rupees. Why would the SBP deliberately weaken the rupee? The central bank insists that these interventions are not designed to harm the currency but to strengthen Pakistan's external buffers. By purchasing dollars whenever there is surplus supply, the SBP builds its foreign exchange reserves on what it considers a more sustainable basis, reserves backed by market inflows rather than short-term foreign loans. From the SBP's perspective, a slightly weaker rupee also discourages excessive imports, protecting the balance of payments. It helps maintain a cushion of reserves at a time when Pakistan is struggling to stay afloat in global financial markets. But at what cost? Critics argue that these purchases distort market dynamics and contradict the IMF's insistence on a freely floating exchange rate. Artificial weakening of the rupee makes imports costlier, fueling inflation that ordinary Pakistanis feel directly in their household expenses. Energy, food, and industrial inputs all become more expensive. The weaker rupee might buy breathing space for the SBP's reserves, but it comes at the price of public frustration and economic strain. Moreover, by keeping the rupee artificially depressed, the central bank risks sending a negative signal to investors about the true strength of Pakistan's economy. Confidence already fragile weakens further. The bigger picture, the rupee debate is more than a technical argument between economists and policymakers. It reflects Pakistan's broader economic dilemma. Should the country focus on short-term survival by building reserves at any cost, or should it allow market forces to decide the rupee's true value, even if it means volatility in the short run? In the end, the SBP's strategy may stabilize reserves, but it also risks prolonging inflationary pain for citizens and undermining confidence in market reforms. A currency is not just paper and numbers, it is also a measure of trust. And trust, once eroded, is the hardest reserve to rebuild.